Stocks on Wall Street mixed, kicking off a big week filled with Federal Reserve rate decision, the monthly jobs report, and a lot of earnings from more magnificent 7 tech heavyweights. Joining us now to break down what to expect from all of this action-packed week is Dennis DeBusschere, 22V Research President. Dennis, it's good to see you. It's been a little while, so great to have you here and to get your perspective. We just heard about that Treasury announcement here, sort of just already adding to concerns about a higher for longer rate regime here, and that percolating through the Treasury market as well. What's your reaction to that? And do you think that we are higher for longer here? And what does that even mean?
Yeah, I mean, for sure, I do think we're higher for longer. And I think the definition of that would be the Fed keeping the federal funds rate around current levels until they're comfortable that inflation gets, I guess, like a better term, under control or in line with their targets, which around 2.7% on core for this year, and then closer to 2.4, 2.1% next year. To your point on the auctions, or better yet, the amount of funding that is required, it keeps creeping higher, which means it's even more critical that you do see inflation come under control. Because if that doesn't happen, then supply will be harder to absorb by the private sector. You have a higher implied deficit, certainly with higher nominal interest rates. Inflation only would add to that, so meaning pushing up interest rates. So yeah, it's really important that inflation gets under control. I'm actually a little bit surprised since the CPI report that 10-year yields aren't higher. So that is a bit surprising. Maybe there's a better inflation, meaning more dovish inflation to come, but that is a bit surprising to us.
And Dennis, when you say bringing inflation under control, clearly we saw a lot of progress in that fight. Now we kind of stalled here. What do you think does get us, to that last mile here, Dennis, to Jay Powell's target? Do you have to see the economy meaningfully weaken, Dennis? Does it mean unemployment has to ramp? What gets us there?
Yeah, there's three main things: wages, wages, and wages. Like when it comes down to inflation and your forecast for core services, which is what we're all kind of trying to figure out where and how high that's going to be in the future, wage growth is critical. And then to your point, will wage growth get to like closer to 3.5% from, say, the current 4%, just by normal labor market loosening, quits rates coming down, just less hiring, or will you need a much higher unemployment rate? That's the critical question. So far, wage growth has slowly come down, but it's stalled. And it's stalled in a way that makes people concerned that inflation will be too high. The Fed would eventually have to tighten financial conditions again. The unemployment rate moves higher. So I think you need some combination, or our call is that you need some combination of like 2 to 2.5% economic growth. I mean, maybe a little bit weaker. And then you'll be comfortable that wage growth will come down in a way that the Fed can be comfortable with, meaning we don't need a much higher unemployment rate. If we stay with economic demand that's like well above 2.5, and the initial launch here into 2Q is a pretty strong one, then tighter financial conditions could be needed, and that would probably be associated eventually with a higher unemployment rate.
Dennis, at the same time that wages perhaps need to come down or stabilize at least, we've had goods inflation that has been ticking up again. There was a chart that Torsten Slok of Apollo shared today looking at manufacturing PMI prices paid that showed a coming potential rebound in that goods inflation. So this then makes the Fed's job even more difficult, right? Because as we've seen in the past, they don't necessarily have a great lever to pull when it comes to this type of inflation, do they?
They don't, but I think the good news there is that the goods inflation you've seen is going to be very difficult to extrapolate, right? So on a 3-month moving basis, core goods prices were down like to negative 2.3% in December. They ramped up to plus roughly 2.8% exiting 1Q. A lot of it was like consumer electronics driven. There was some kind of finance pricing in there that you want to get into the weeds too. It's stuff that I wouldn't extrapolate. You could be pretty comfortable that goods are going to come back down a little bit, but probably not enough to offset wage growth. So I'm not so worried about goods prices staying around current levels. You'll probably see them come in a little bit, but not enough, to your point, not enough to offset core services inflation if wages don't come down more. I mean, it's very simple. If wages don't come down more, you can, again, in line with what the Fed needs, call it roughly 3.5% over time, then you can rest assured that rates are going to be higher for longer, roughly around current levels, with some threat of an increase. And that's the world we'll live in until, the labor market has loosened comfortably.
And Dennis, so we're talking Fed. Let's switch gears and talk earnings as well, because we got some big names on tap this week. Got Amazon, got Apple. Just interested, Dennis, what you've learned so far this earnings season. What have been your big takeaways, and have you adjusted where you want to be invested as a result?
I haven't really adjusted where you want to be. I mean, 45% of the index as of this morning had reported. 80% of companies are beating. That's well higher than normal. I guess one of the positives of higher inflation is stronger earnings growth. So if you have relatively stable 10-year yields, and that's what we have now, relatively stable and positive earnings growth, it's very difficult to be negative on the market. I think one of the main takeaways, if I had to put it on something, is that it's not all just big tech. You are seeing some broadening out and improvement in earnings, financials and banks in particular. I mean, normally when we've seen these increases in tens from the CPI report, banks and financials have come under intense pressure. That didn't happen this time. There were some big ones, that we saw, but the regional bank index is acting much better than you would have thought, given the increase in 10-year yields, because earnings have been more stable. Even REIT sentiment for earnings has improved pretty nicely. So there is a broadening out and improvement in earnings. Theoretically, that should be good for the quote unquote average stock relative to the Mag 7. But yeah, I mean, it all for naught if we don't get inflation under control and 10-year yields are just going to keep on driving higher, because then we can reasonably assume that earnings growth will come down if 10s go up a lot.
All right, we'll see what Jay Powell says and does on Wednesday. Dennis, thanks so much for joining the show. Appreciate it.
Thank you.